Hi, this is Mani from bse2nse.com. So this is my second follow-up video on options trading basics. And the first video I talked about basics of options and mostly focused on the buyers in options. And to watch that video and to get the fundamentals on what is a strike price, what is a premium in options, and watch that video first. I'll make a link within this video itself to click and watch that video. So click on it and watch that in case you have not watched it. And to next move on, this video I'm going to talk more about options writing or a seller in the options contract and how you can benefit from that, and what kind of strategies you can look to do based on what kind of fundamentals like the Bollinger Band and so on. So let's get started with this video. And an options contract, as you know, is getting formed between a buyer and a seller, meaning a buyer is going to bet that market is going to cross a particular level. A seller is going to say otherwise, meaning he'll say that it is not going to cross it. So as you can see here, a buyer is, for example, I'm going to take the example of Nifty all across this video. So a buyer will bet that the Nifty index will cross the strike price. So there are various contracts at various strike price levels. So assuming Nifty is at 6,000 today, and there is a buyer for 6,400 call option. So the buyer is going to bet that market is going to cross 6,400 by end of this month, and he's willing to pay a certain price for that, the premium. A seller, on the other hand, is going to bet that market will not cross 6,400 or a particular level, and he will take that premium from the buyer. So these two people enter into a contract or like a betting agreement, wherein one guy is going to say markets are going to cross a particular level, the other guy is going to say it is not going to cross, and he will take that premium initially. And when they square off during the expiry or at any time interim, they will again get back the premium, and they'll again lose the premium. So it's more like cricket match betting, wherein one guy can say that Tendulkar will hit 100 in this match and pay, let's say, 100 rupees, and the other guy may be betting that he will not hit 100 today, and based on the outcome, meaning if Tendulkar hits 100, the buyer will win and the seller will lose, and if he does not hit 100, then a seller wins and then the buyer loses. So basically the premium paid by the buyer goes to the seller, and when the seller again chooses to square off or the buyer again chooses to square off, the reverse will happen, meaning the buyer will get back the premium when he's selling, and the seller will need to give back the premium when he's choosing to square off his positions. So the profits made by a buyer is a loss for the seller and vice versa. And uh, again, there is both call option and put option. So there's going to be people betting that markets will go up and go down. Similarly, there'll be sellers who will be betting that markets may not cross a particular value on the upside, and there'll also be people betting that markets will not go down below a certain level on the downside as well. Okay, so to better explain, I'll move on to a chart wherein I'll start explaining, and that will also help you understand the strategies that you can do as an option seller alone. So this is a Nifty chart for the last 3 months, and the candlesticks you can see, each candlestick represents one day, and you have a gray line here. This is the Bollinger Band. I'll show you where you can get this chart. You can get this chart from my website bse2nse.com, and on the right you can see the levels 5,800, 5,900, 6,000 until 6,500. Okay, So and on the bottom you can see the time frame December, Jan, and then the start of Feb here. All right. So the Bollinger Band actually represents upper side and the downside resistance and support zones. So for example, as a seller, I know for a fact that most likely markets historically also, if you see, Nifty normally does not move by more than 300 or 400 points in a month. It will normally move less than that. So as a seller, as an intelligent seller, people will be looking to sell contracts on both the call option and put option. So let's say I'm going to draw a green line where markets like a center line where markets are hovering around, for example, somewhere around 6,200, this green line. And we know this that the Bollinger Band is flat and the markets are range bound. They are not moving much upside or downside. So as an intelligent seller, what I look to do is I'll draw a red line across the close to the Bollinger Band, so somewhere around 6.4, and a lower Bollinger Band somewhere around 6,000, right? So at any point of time in the last 2 months, you had an opportunity wherein markets were close to 6,200. Like there are a lot of spots. I'll mark those in black. For example, here, 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 and here. As an option seller, what we will basically look to do is 6,400 call option. So let me mark that at the top here in a text format, right? Nifty 6400 call option, right? So that's the call option, and I'm gonna mark all right, I'm gonna mark this in green actually, since I'm expecting markets to go up. So I'm gonna mark this contract in green, meaning I'm expecting it to go up. Let me see if I can put this in green. Do I have color options? No, I do not have any color options, so I'm gonna leave it as black. And at the bottom I'm gonna say Nifty 6,000 put option. Nifty 6,000 put option, right? So basically markets will normally tend not to break the Bollinger Band on the upside or the downside by too much within a month. It may gradually tend to go lower and the Bollinger Band may drift lower, but within 20-30 days time frame, you're mostly not going to see any major downside or any major upside. So I'm going to mark this in green, right? So as an option seller, I'm going to predict that the markets are not going to enter into these zones. This zone I'm going to actually mark in red, like I'm going to draw lines like horizontal lines. Right. So I don't expect markets to enter into this particular zone here at all, because I know the Bollinger Band, the upper band will be looked upon as a resistance and there will be strong resistance, and unless there is a news-based event or a strong economic factor that will push the markets higher, markets are going to face resistance at the upper Bollinger Band, and similarly markets will find support at the lower Bollinger Band. So I will also predict that markets are not going to go down. So a relatively good strategy for an options seller or an options writing strategy will be to write both a call option and put option, which is very close to the upper Bollinger Band and the lower Bollinger Band. While there will be people in the markets who will be betting, who there'll be call option buyers and put option buyers who will be betting that markets will go down below this zone or this shaded area, the shaded area that I've marked in red lines here. So there will be a lot of people who are betting the other way also for various reasons, but a smart option seller will mostly just look to bet that markets will not be crossing certain levels on both sides. So when markets at the end of the month is not actually entering into this shaded area, you will actually be gaining both the premiums that you sold in the put option and the call option. So while the buyers of the options contract in both these zones will be losing out. And of course, you cannot expect 100% accuracy all through the year. Out of 12 months, you may lose like 2 to 3 months. But if you choose to sell at the proper levels, like assuming when markets are close to 6,200, the green line that I've drawn, like the neutral line that I've drawn, when markets are close to the exactly halfway between the upper band and lower band, you can sell the contracts at the upper band and you can sell the contracts at the lower band, and which will be normally at least like 200 300 points away. If you sell those contracts, then you're pretty safe. For example, right now you can see that the lower band is close to 5950, the upper band is at 6400. So you have a space of 5500 points wherein most likely market will settle down between this zone during expiry, and you as an option seller you will gain pretty decent amount. And to actually give more information, to sell a contract, to sell one options contract, you will need a margin of close to 20,000 to 25,000. And in Zerodha, I think you may have some additional benefits. So let me make a new slide here. I think let me just leave it at that, because you will approximately need 20,000 rupees to sell one options contract. And assuming, let me check the values of 6,000 and 6,400 options contract in nseindia.com. So here we go. 6,400 call option, and I think this month is 26 Feb. We're almost close to end of it. So 27th March. So you will normally be able to write options contract which is worth approximately 30 rupees, and 6,000, the lower Bollinger Band, is actually, or 5900 is close to 60 rupees. So normally when you're writing, you should be able to write options contract which is worth approximately 30 to 40 rupees, let's say 40 rupees on an average every month, which will mean you put yourself at a position where you can gain 2,000 rupees per contract. And to write an options contract, you would need a margin of around 20,000 rupees. So basically you will look to write options contract which is at the lower Bollinger Band and the upper Bollinger Band when markets are midway through the Bollinger Band, in the middle of the Bollinger Band. And for 20,000 that is required as margin, you can make 10% returns on your capital per month if you do it properly and if you do it in a disciplined manner. And in Zerodha, I think if you write both sides, you may get additional margin benefits. And I am an authorized person for Zerodha, and I offer free training for clients who open Zerodha trading account through us. You can log on to bse2nse.com to fill in your form of interest, and you will have a lot more strategies and insights from my side once you join Zerodha through me. So let me show you how you can get this chart from my website. Go to your browser and type in bse2nse.com like I'm showing here, right? bse2nse.com, and here you have the traders chart. Click on the traders chart at the top of my website and click on Nifty. And the first chart that you get here is once you click on this thread is the intraday chart. So as an options contract writer, you need not look at the intraday chart. Come still further down. Then I have the 5-day chart, and then I have the Nifty 3-month chart, and this chart will get updated on a daily basis. This chart has more technical indicators than what I've indicated in shown in this video, but you can see the gray line, the upper band and the lower band. So to check this chart on a daily basis or to keep checking regularly, you can log on to bse2nse.com. And to sign up for Zerodha, you can again go to bse2nse.com. And the second link from the left that you see here is the Zerodha Open Trading Account. You can click here and you can fill out the form of interest here. You can fill in your name, mobile number and email address and click submit. And we'll get back to you, and I'll be giving you a free training once your Zerodha trading account is open. So that's it for now. Any questions or any queries on options writing, post in this video. Subscribe to our YouTube channel to stay in touch for more interesting videos. And that's it for now. Thank you. Bye bye.